it really has taken sort of 2 to 3 years for it really to become meaningful to our team members as they're getting $10,000, $20,000 in their ESOP account.
Sure.
Yeah, it's going to be really meaningful wealth for their families.
Welcome to P&L, Priorities and Lifestyle, with your host, Rob Schultz. Rob is the founder and president of Schultz Wealth. All opinions expressed by Rob and his guests are solely their own opinions and do not reflect the opinion of Schultz Wealth Limited. This podcast is for informational purposes only and should not be relied upon for investment decisions. Please refer to our website for more information.
Welcome everybody to P&L, Priorities and Lifestyle. I am your host, Rob Schultz, and today I have a retread. Chris, you were on our show, episode 13, about 2.5 years ago, and I guess we somehow were able to talk you into coming back.
It did.
Yeah.
It was easy, actually. So
it was pretty easy. Yeah. So really glad to have you back. This is Chris McKee, formerly the CEO of Venturity, founder as well. Mm-hmm. And we've got good stuff to talk about because that is not your role anymore.
That's right.
You are officially not involved in day-to-day operations at this point, chairman of the board, and have successfully done a leadership transition, as well as we'll talk about the second stages, I guess you could say, of the ownership transitions that you're doing within your business. And we're going to geek out about accounting stuff because we're both kind of accounting guys, and don't get scared because I was like, when we did this the first go around, for episode 13, I was like, oh man, this is going to be so boring. It's like
accounting.
It's two finance guys, and we're just nobody's going to listen to this. It turned out to be, that was really one of my favorite sessions because I thought that you just brought an amazing amount of just a wealth of resources in a critical area for our listeners. They're all closely held business owners. Most of y'all, started out at ground zero and worked up. And Chris, you have spent your career working with that particular type of client, helping them with that accounting and that bookkeeping, that financial accounting and bookkeeping arm of their business. Mm-hmm. Can you tell us a little bit about that journey and what you do at Venturity for your clients?
Yeah. Just to kind of recap. So Venturity, I founded it in 2001. And really the idea was, at the time I was out on my own helping people clean up their books, and really realized that, I'd clean it up and give it back to them. And 6 months later, they call me back in because it got messed up again. Yeah. And I realized it was just a lot of small to medium-sized businesses, growing businesses really struggle to attract and retain good accounting people internally. When you have a one-person accounting department or a two-person accounting department, it's really hard to create a career track for those folks. And so it's just much easier to take that function and outsource it. Mm-hmm. And so at least that was my idea at the time. And, 23 years later, it seems to have gone pretty well. So, so we've got over 100 folks now between Dallas, and then we have a team in India as well that do a lot more of the transactional type work. Our team here in Dallas really is focused on more of the client relationship and client facing piece of it. So.
Okay, so for somebody who closely held business, starts working through things. Next thing you know, it gets a little bit more complicated, and you're who they can go to basically close those books every month, make sure that everything gets reconciled, and that you can trust your numbers.
Yeah, pay the bills, pay the employees, everything that an accounting department would do. I like to really say it's really the controller on down, when it's that point at which you're doing it yourself, and then maybe your wife is doing it for you.
Absolutely,
and then you kind of get beyond that, where you've got to start really having a full-time person. From there, all the way up to even a 5 or 10 person accounting department, we can really manage at this point. So
that's fantastic.
And then the piece that we added a few years ago, about 4 or 5 years ago now, is, we worked with our clients in that accounting role, that bookkeeping role, if you will, for so long. And our clients really were pulling us in the direction of saying, hey, you give us this great information, but we need somebody to help us strategically now know what to do with that. How do we look forward? How do we take this information and analyze it and figure out what the key measures in our business are, where we're making money, where we're not? And so about 4 or 5 years ago, we added fractional CFO services as well. And it's just been a great complement to our core accounting services piece as well. So it really is now a much more comprehensive solution. And not every one of our clients uses our fractional CFO services or even needs a fractional CFO. But when you get to that point where, all right, now I know I've got good financial information, but I need to figure out strategically where I need to take my business and start looking out ahead. That's where one of our fractional CFOs coming in really helps our companies.
That's so important. We've talked on this show before about how crucial the financial aspect of your business is. And in every one of our businesses, I think we have areas of strength and areas of weakness. And we've talked about before a three-legged stool. Where you have your obviously your marketing. Can't do anything unless you have clients. You have to have operations, because once you have the clients, you have to be able to make sure that you can do what you do. And then finally, you have to have good accounting. And if any one of those is weak, it can take down your whole company, because it's a three-legged stool. One of those is a little short, you're going to fall over. And I would say that in closely held businesses, a lot of people that start businesses don't have that accounting background, and they've become really successful because they're creative and they found a new cool way to do something or to market something. And this financial piece sometimes gets dragged along. And so it's really great that we have companies like Venturity out there that can help with this kind of thing, because I can see where it's like very important. The other distinction I wanted to make is that you do not do tax accounting.
So, that's a great point. So we don't do tax accounting or audits. That's more a traditional CPA firm, if you will. And we actually, if you think about kind of the world of accounting, everybody thinks about accounting. Well, all accountants are they all know accounting and they all know taxes. But it's similar to like a physician. Like, you have doctors, but then you have doctors who specialize, and you have a cardiologist and a neurologist. And, if you have a heart problem, you're not going to go to a neurologist. And I think what a distinction people have trouble kind of getting their head around is, as accountants, we have sort of financial accountants, which really kind of keep the books every day and according to what they say, generally accepted accounting principles. And we're really good at kind of the debits and credits. Then there are tax accountants that are really just a separate specialty, and they spend all of their time figuring out tax laws and studying tax law and figuring out how to save you on taxes. But that's sort of a once a year sort of filling out a tax return, and they can advise you during the year on ways to save on taxes. But in terms of sort of understanding the metrics of your business, that's financial accounting, and they're two different specialties. And so I have a world of respect for the tax people, and they spend all of their time, as I say, really understanding and staying on top of that. And so when a tax problem comes up, we turn to those guys. And
Absolutely.
we like to really partner with tax firms across different specialties, so that we know that we have a firm that knows this industry and a firm that knows industry, because they know the peculiar tax items for a particular industry, and they can really be great advisors. So we're very agnostic in terms of the tax providers that we work with. It's like, hey, we'll get the accounting done and then partner with a great tax provider, have them be their specialty and have us be our specialty. So
thanks for making that distinction. And another thing, just as business owners, just be aware that it takes a team of people to support. And those of us that are that team, we all kind of know what our spot is, and generally the good ones welcome the support of other experts in other areas. Like, for instance, you have your financial accounting, that you have your tax accounting, you have your personal financial advisor, you have all these different team people that have their specialties, and what we try to do is we all try to communicate with each other and come up with fantastic solutions for our clients.
Yeah, and you
right?
can't possibly be an expert across all of those things and stay on top of all of the changes in those various aspects of, for instance, financial support. So So we really focus on being that great accounting department for our companies, and then advise them around that with our CFO services.
So spending all this time, basically entire career in financial accounting, I think when we talked last, I just thought it was fascinating how you came up with your transition plan. We're roughly about the same age, I think. Kind of I think we might be exactly the same age. I'm 57.
I'm 35. So
no, you're not.
Yes, I'm also 57.
I think we're the exact same age. And so you've kind of grown up, working with business owners, and just probably like me, same thing. I sit there and just recognize, wow, this is a huge problem. This coming up with the way to transition, and you did a fantastic job on yours. First of all, you started early enough, okay? Because we both have clients that start like when they're 70, right? That you started early enough thinking about it. You were very intentional about it. And you came up with a very unique way to transition not only your leadership, but also the ownership in your business. And I'll just cut to the chase on that. You have an ESOP, okay? And I talk to people about ESOPs because, we have this term called enterprise values. So we talk about a lot on the show. And when you get ready to transition your business, it's not about the value, trying to get the highest number you possibly can. It's to really be happy about it. You have to do it based upon your values and feel good about not only what you're able to take off the table and take home for your family and for your legacy and everything, but also what you leave as far as your company. It's very important. And then yet, I talk about ESOP sometimes, and people go, "Oh yeah, no, we don't want to talk about that. That's such a just unique small area over here." It's just
I don't complicated.
It's complicated.
You can't make any money doing that. Yeah.
But some of the best transitions I've ever seen actually were ESOPs. And yet they're just so rare.
Yeah.
Why are they so rare? Is it because of the complications, you think?
Yeah, I think that, reputationally, there's a lot of rumors and supposedly conventional wisdom around ESOPs that they're complicated. There's a lot of nightmare stories about ESOPs that have failed, all of those kind of things. And what you find when you really kind of dig below the surface a little bit is a lot of that ESOP failures are relatively rare. An ESOP transition tends to be much more successful more often than a typical maybe capital-based exit, whether it's private equity or strategic, if you want to ensure sort of longevity of your company. But a lot of maybe the other people that bring other exit strategies will, take the opportunity to talk down the ESOP, because if someone goes ESOP, then they can't go private equity kind of
Well,
thing,
that's true.
So,
yeah.
So I think that, so I'll kind of go back, if you'd like me to, maybe talk a little bit about kind of how I got to both of my transitions, and they are two different transitions, leadership and ownership.
No question.
And I think that was the first part of my discernment process, because really it was probably 5 or 6 years ago. I was starting to look at, so it was in my early 50s, and I need to start thinking about what that's going to look like longer term. And, I was really focused on this idea that I would sell my company and leave. And those two things were sort of would happen at the same time, because I feel like I would make a terrible employee for somebody else who bought our company. And so that was one of my beliefs as I went into the process. And then we also had a series of values as a company around really trying to steward our company for the long term and provide a great place to work for our team members for the long term. And so my biggest concern in a sale was really taking care of my team members. Now, not everyone has that focus, but it's something that the people that are on our team really helped us build it over the last 20 years. And so I wanted to make sure they got taken care of. So as I was talking with as I was looking at various ways to transition ownership of the business, I just kept running into this wall of, gosh, when I sell, I'm going to have to leave. When I sell, I'm going to have to leave.
And I'm too young to leave, right?
I'm still enjoying what I'm doing, and I want to be a part of this. And we've built this, what I feel was a great culture, or is a great culture, and I wanted to be part of all of that. Mm-hmm. I sort of set that conversation aside. And I did a lot of research and decided, okay, I don't know that I'm ready to deal with that. So we actually, in the meantime, needed to improve profitability of the company. And we started to look at open book management. And so we started sharing financial information with our team and opened up the books to them. And it really helped to grow the company. And it was a great sort of entree into seeing what the team members can do, being a part of the financial success of the company.
Which is kind of what an ESOP is in a lot of respects. So
it laid the great groundwork.
Lays the groundwork because in an ESOP, obviously, as an employee, you're getting incentivized based upon the value, the success of the company.
You're an owner of the company,
and you're able to see all of it. And yet, and we talked about this probably before, for whatever reason, as closely held business owners, we just hold it really close to the vest, right? We don't want to share, that accounting information. It's like, oh my gosh, they just won't understand that. I don't want to share that with them. And yet, public companies do it, but we won't do it. But you were brave in opening up the books to all of your employees. And not only showing them, what the books look like, but also giving them skin in the game, where they were able to take responsibility for parts of your financial success, and were incentivized by it. Correct?
Yeah. We put a bonus pool in place that basically exceeding a certain percentage of gross margin, they got 50 cents every dollar over that into a bonus pool, and we split it among the team. And I think the cash bonus is nice. But them being able to see how we were performing financially, and then how they can impact that, and obviously impact their bonus, but also impact the success of the company, because that means that they're going to have a place to work for a long time to come. Yeah. And it built trust with the team and built engagement. And so it really laid a great foundation for what eventually was the path we decided to go from an ownership transition standpoint. Once we opened the books, I really saw the kind of impact that sharing financial information and making people part of the company could really have. And even before they had ownership in the company, they had emotional ownership in the company, and it really moved the needle for us. I opened the books because we were struggling financially, and I just I thought, well, I've tried everything else. And so why don't I get some help from the actual people that are working for me and see if we can all work together to make this thing better. So once I saw the impact of that, there are a lot of companies that do open book management that then become ESOP companies. And I hadn't, and again, in my first sort of look at ownership transition, I hadn't looked at ESOP. I wasn't aware of it. And then when I did, I thought, well, this is very much in alignment with who we are. I mean, all these people have helped me build this. Now they're really helping me grow it and be much more financially successful. And it's going to be a great outcome for my family financially. Well, an ESOP is an opportunity for me to sell that to them. And then when they leave the company, the ESOP buys their shares back. And so it's a chance for them to have a liquidity event when they step away from the company, when they retire from the company. Yeah. And so I want their families to have that same opportunity that my family did. Yeah, and so
part of the team. Absolutely.
Yeah. So it's been good. So we did that in 2020, and we're a little over 3.5 years in now, I guess.
Yeah.
So,
yeah. Getting there
almost
for
3.5 years. Yeah. So.
Yeah. So one of the challenges that ESOPs sometimes have is, so you're selling to the employee, so you're dealing with this ownership part of things, but what about the leadership part?
Yeah,
sometimes the ESOP isn't ideal for that, because you're sharing ownership all the way throughout the entire company, but yet the leadership may still fall on you. Okay. If you haven't thought about that, or if you don't have like a Deanna Walker, for instance. So let's talk about that. Let's talk about it, because the leadership part had to come alongside the ESOP to be successful, I would suspect.
Yeah,
to be able to get you where you are right now.
Well, it was nice. So once I figured out the ESOP transition, I thought, well, here's a way that I can transition my ownership without having to address the leadership thing quite yet.
Okay.
Because at the time that we did the ESOP, we didn't necessarily have. I thought I had probably quite a bit of time left in the business as the CEO, and I had some rough plans for what I wanted to do eventually. But we did. Answering the ownership question first really helped free up my mind to, okay, I can start transitioning my ownership, and I can then let the leadership piece follow its own track.
So for you, it was you wanted to solve the ownership piece first. It sounds like.
It just sort of happened that way, to be honest with you.
Okay. I can see that though, because like I said, I still feel like we're relatively young, you know, and have things to contribute. And so you're going, okay, I'm gonna transition the ownership, because I know that's something that I need to do,
and I have a solution for it.
And I
found that one first.
And you found it, and it's like, so I'm going to do this, and then kind of the leadership part. So how did that start to occur in your mind?
And I'll tell you, they were both mushed up in my mind. Until I found the ESOP deal, and I didn't, and the ESOP. By the way, the ownership transition, I didn't sell 100%. I sold 20, and then I'm going to sell another 30, and then I'm going to sell 50. And so that's the remaining 50. So that's over about a 10-year period.
Okay. So wait a second. So you did 20, and then you're going to do 30%.
30%. So it'll be the ESOP will be 49.5%.
So you'll still be majority owner.
Still be majority owner
by a little bit. And then after that, and is this based upon a pay down of debt or something like that?
Yeah. So as I sell each tranche, we bank finance each tranche, and then the ESOP pays down that debt from distributions from profits. And so, with that first tranche from 3 years ago, we did a 10-year note, but it looks like we're going to pay it down in 5 years. And so we're going to be ready for the next 30%. And that was what I hoped would happen, because, our growth and our earnings have accelerated since not just open book management, but especially since the ESOP. And so I sold the first 20% in at $26 a share. And by the time, so we're about to share with our team this week the latest share price, but we had a valuation done at $12.31, and our latest share price is $64 a share. So it's more than doubled in just 3 years. Okay. And that's really the impact that the employee ownership has had. So I'll sell another 30 and then 50, and so it'll eventually be 100% employee ownership. So that is sort of the ownership side, and that some people need to solve the leadership side first and not the ownership side. But the idea of separating those two, if there's one thing I'd leave you with, Rob, is just this idea that they don't have to follow the same path. If you can think of them, they are two very different things. Yeah. They can follow the same path and they can be the same thing. But for me, it was very freeing to think of those as two different things.
I can see that.
So I'll get back to your question on the leadership side. So yeah.
So because we hear that a lot too. It's like, well, I'm ready to transition, but I just don't have that person or that team's not there. Mm-hmm. How did you find that?
Yeah, I will say, I got super lucky, and there was a little intentionality about it as well. Look, I got lucky in that my CEO successor came on board with me about 3 or 4 years after I started Venturity, and she's was how you talked about earlier, the 3-legged stool.
Yeah.
So I happened to, when I started Venturity, one leg I had really down was the financial stool.
I would think so.
And I had the operations leg down as well, because I knew how to close the books on, I had to do accounting, which is the operations side of what we did. I'm an accountant. That third leg, the sales piece.
You don't even have to say it.
So that was where Deanna really came in, and she came in as a part-time salesperson and grew over 20 years to be our chief revenue officer, and really was my right-hand person for a number of years. And so, we had talked on and off about her being potentially a successor. But we both had various times where we were like, well, I'm not sure that's the right answer. Even she wasn't sure she really wanted to be that. But, I will tell you what happened to kind of give you maybe to distill it down to a pretty brief summary. Is I always had this idea that I wanted to do something after Venturity, and that was teaching. I want to kind of teach at the college level. And so that was always something that was out there. And I always told people, well, I'm going to do that in about 3 to 5 years.
Yeah, the 3 to 5
3 to 5 years.
Yeah.
That's right.
Yeah.
That's exactly right. And suddenly sort of 8 years went by after I started talking about that. And I was still enjoying myself and still having a good time. And so I kept sort of putting it off. And then I will tell you, kind of starting about maybe a year and a half ago, I realized I was just struggling to drag myself out of bed and come to work. And I was like, why am I like, what, what's going on here?
Mm-hmm.
Like I'm the CEO, like everybody wants to be the CEO. It's like the best job in the world, at least from the outside. And like, why am I struggling? And I just, I really, I couldn't figure out what it was. And it came out in frustrations around things that were happening at Venturity. And in the meantime, the team was growing the business and they wanted to take it to a place where we were doubling revenue. And I'm like, I don't know that I can run a business that big, And so I was having all these signs that in retrospect were signs that it was time for me to hand off the reins. But I didn't know at the time. There were frustrations about other things in the business. So I started working with an executive coach, a CEO coach, another CEO that ran a much larger company, and ostensibly to help grow me to, we were $10 million at the time, and to be a $20 million company, or a $30 million company, which is now kind of where we're headed, which just amazes me. And so, I was just like, all right, you got to help me sort of get ready for this. And the more that we talked, the more we realized that now I think that I've accomplished everything I want to accomplish with Venturity, and it's time to really hand it off to somebody who really is excited about taking it from 10 to 20 to $30 million. And so
that's what it was.
Yeah.
Then.
Yeah. As crazy as it sounds. And I would have thought that I would have, wanted to do this at least another 10 years. Mm-hmm. And, there's a great book that my coach recommended to me, that I'm going to blank on the name, but I'll come back to it. Yeah. But it was great about kind of the stages of your life. And there really is something, and it's not really so much a midlife crisis, that you kind of come to. People come to it in their late 40s or sometime during their 50s, where they say, it's just time for something different. I mean, I've done all I'm going to do in this. And that's really, so it was definitely a very emotional time. And it took me a good, probably 9 months, maybe even a year, to really think about, all right, if this is what's really going on here, that it's just time. So
well, that's really courageous in a lot of ways, Chris, because, when you start a company and you build it, you get it to 10 million, going to 20 and so forth. It's just like, go, 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 and so it takes a lot of courage to recognize that, that's not really
it's
what
scary.
I want.
You're right. Courage is
and then the second part is like, okay, well, that's not what I want. Well, what is it that I do want? what am I going to do? Because I can't just hang out at the house every day. You can't do that either.
Yeah.
So this teaching thing, I know, because we've talked before, this is kind of what you're excited about is, going and kind of giving back, mentoring in a college type environment.
Yeah. It's what I've done. Cool. I've done a lot of that during my time at Venturity. So it's sort of a next natural step for me.
Okay.
So right now I'm effectively on a break as I've handed things off to Deanna. And so, but
you liking your break?
I'm liking my break.
Okay,
yeah.
So good. Okay.
So I will get on. I will hopefully, if I am lucky enough to find a teaching opportunity at one of the universities, certainly by next fall, I'll be teaching hopefully. So.
Okay. All right. So this leadership transition to Deanna. So how long did it take? What were some of the lessons learned? As you did some of that?
This is a great question because I mean, after I sort of figured out that it's time,
mm-hmm.
I was like, oh crap, what am I going to do now? And so I started thinking about it, and I realized that I really did realize that Deanna was the next natural leader of Venturity. It made a lot of sense, and so I approached her and just started the conversation and said, is that something we've talked about it on and off over the years? Is that something that you might be interested in, because that door might be open? And fortunately, she came back and said, well, I'm glad you asked, because I would be interested. And and so now Deanna is the same age that I am.
Right. So it's not a true G1 to G2 type transition.
Right.
So it's going to be really important for her to, from this, immediately be building her leadership team as well.
Exactly.
Yeah.
Exactly.
Okay. Y'all recognize that.
We talked about that. And so, the idea is, I think, so I'll sort of walk through the process a little bit. So, and I will say my coach, who CEO coach, was a big help. And it took me years to find the right one. And so I worked with a guy, Steve Schiffman, who ran a company called Michelman. He was, I think, the third or fourth generation. It was a family business, but he had been CEO for 20 years, and he had just handed off the reins to another family member. And so they were very intentional about that. And obviously they've had 3 or 4 CEOs. I guess he was the third, and there was a fourth that he handed off to. And so they had that process roughly down. And so we were able to learn a lot from that. And I think that was what was important for us, is to think of this, to separate the idea of the fact that, okay, I'm the founder of the company and all of the things that go along with it. But my CEO role is just a role. It's the role of the CEO. And what we're doing here is, and I'll always be the founder, and that's going to be what it is. But we need to think of it in terms of a company that's separate and apart from Chris McKee, and that this is just a CEO transition. And if we're going to be a 100-year company, if we're going to be around for decades to come, this is just the first of what will be several CEO transitions. And putting in that context took a lot of the pressure off of it. And the idea that Deanna and I could talk about the fact that, okay, you're taking over from the founder, which is probably the hardest CEO transition to do. But the first thing that we're going to do is start thinking about what your CEO transition is going to look like. And so who's the next person that's going to be after that, and what your timetable is. And so we have a rough timetable for when she's going to hand over the CEO reins. And so you just think of it in terms of a longer continuity. And that took a lot of the pressure off of things.
That's pretty cool, because you were able to separate, because we all have identity and worth from the companies that we build.
Yeah. Oh, yeah.
And so I like the way that you separated that. Said CEO is a role, founder is kind of who you are.
Yeah.
In a lot of senses. And I think that's really, because this is a very behavioral kind of situation.
It is. Yeah. Look, we've got a successful company. It was the right time.
Yeah.
It couldn't have been a better time to make, and it's actually been more successful in the 4 or 5 months since my transition. So
that's a definitely something that you want to see. We watch a lot of the public companies and so forth when they have these transitions, and you had this CEO, this big personality person, they try to hand it off. I'm thinking about Eisner, Disney, for instance.
Yeah.
And just can't do it, right? And it's not so. Really that demonstrates a failure of leadership on that first sense. And I think that, when you're able to hand something off, and I'm a Navy guy, so I say able to hand the ship off to somebody else, and the ship's better than it was when you were leading it, that's a direct reflection on your leadership in so many ways. I really do believe that.
Oh, thank you.
And so, and I try to think that way, and I think it's important for us to think that way, that what we really want for our companies, for them to be, have greater success in the next step, kind of without us at the helm than it had when we were at the helm, right? That's what we really want.
Yeah.
And yet sometimes, we're our worst enemy when we're trying to create that, because we have all this worth, within this role, as you said, which is really just kind of it's a role. It's a job.
Yeah. I think there's several things that have made it successful so far. One is that I was ready, so I don't feel the need to sort of come back in and micromanage Deanna.
That's huge.
We carved out a role for me in terms of board chair. So I have, and so if you think about how a board works at either a nonprofit or a for-profit company, the board hires the CEO hires the team and runs the organization. So that's my role as board chair. I'm the initial member of the board. We'll expand the board over time as we grow. But my job is to work with Deanna, and we get together once a week for lunch on Monday, and we talk about what's going on. She picks my brain on things. I give her my opinion, but I don't tell her what she has to do. She ultimately, as the CEO, gets to make the decision. And, over the years, it's sort of a role reversal for the way that we've worked together for many years. I was the CEO.
Yeah.
She was my right-hand person. And I would often go to her and say, okay, we have this issue. What do you think? And she would give me her thoughts, but ultimately it was my decision. And that was one of the things we talked about in the transition. She's like, I don't want you to go away because we've worked together for so long in this way. We said, well, let's just reverse the roles where I'm the person that sort of helps, assists, and coaches you, but ultimately it's your decision. And that's where the board chair role has really worked well. So you asked about timing, and so I do want to hit on that. So, I approached her in January of 23, so a little over about 15 months ago. And we're talking about it a little bit during the first quarter. And then we really had a trip to India in early May. And we were going to have a lot of time together. We were going to work with our team over there. And we took that time to really kind of make the decision. So we talked about it, and I said, all right, I'm ready to do this. If you're ready to do this, here's what you're taking on. But, if you're ready, if you say yes, I'm ready to give it to you. And so we made that decision there. And then over the next 2 months, really worked with the CEO coach that I was working with to map out a transition plan, map out my role, including, we had a meeting with him, the three of us, so Deanna and Steve and I, and he asked, well, what's Chris's role going to be? Like, is he going to have a desk and all those kind of things? And the two of them started talking and basically decided.
They decided for you. So do you have a desk?
I don't have a desk. No, I don't. No, I'm. I'd say the main thing I do now is I go in and teach. So I taught a class last Friday. I'll be teaching in a couple of Fridays, and so that's my re-engagement. And so what we decided to do was that that we would announce to the team in. At the end of August.
Okay.
And then the transition date would be December 1st. So that would be my last day as CEO of Venturity, that Friday, December 1st. And then the next Monday, she would be the CEO. And that time from the end of August to December 1st was a time not just to transition responsibilities, but also help the organization transition emotionally. So even I was surprised at the emotional reaction that people had when we made the announcement, because I just think I'm mostly a schmuck. And so I'm just really glad that, people were incredibly kind, and people were sad that I was not going to be necessarily part of things every day. They were excited about Deanna as the CEO because everyone has a world of respect for her, as do I. Yeah. And so we were just, we with the help of that CEO coach, we were just very intentional and try to strike a balance of doing it over a period of time that respected everyone emotionally, but was not so slow. It was right that balance between he's sticking around too long and hanging on for too long, or he's leaving too quickly. And so that sort of, announcing it and having a 3-month transition seemed to work really well for us. 6 months might be better in some situations. And we had told the organization for a number of years that there were going to be leadership transitions. And I had been saying, look, I'm not going to live forever. So we tried to lay the foundation a little bit, but when you make the announcement, it is an emotional time for the organization. So So December 1st was in my last day in the office, and then Deanna and I have been meeting weekly since then. And we gave the organization some space. I didn't go into the office really at all for 90 days, and really more like 120 days almost. And then just this month, I've started sort of re-engaging a little bit.
Just kind of coming in and visiting with people.
I didn't want to do it. I wanted to be very respectful and give Deanna and her management team. She promoted new people into leadership. And I wanted to give them time to gel and give them some space and just sort of be her sounding board and coach. So we've met on, the idea was we're going to meet weekly, but you can call me anytime if something comes up. So she's picked up the bat phone probably twice with specific situations that have come up. But other than that, we've had great lunches together and we've talked very strategically, and it's been fun. It's been a great role reversal, and she's really energized, and she and her team are really energized by the opportunity to take this thing and do something with it.
Wow.
It's just been really fun.
You're really lucky to have her.
Oh, you're not kidding.
Yeah.
It's been amazing.
Because that's the part that can be so tough, is just finding that right person.
Yeah. And I knew a long time ago that I would need to do that, because I don't have, I have 3 children, but none of them have any interest in being accountants. And not that being an accountant in the long term is going to actually be necessary to be CEO of Venturity, which is a whole different podcast, to be honest with you. But my kids have other interests in their lives, and they were like, it's great that you're CEO of this company, but we have no desire to ever work for Venturity. Yeah. And I'm like, I completely respect that. I mean, like we've had family businesses in my family, and a lot of dysfunction around that, with people being expected to come in and run the business. And so I have to admit that that I did a lot to keep Deanna on board, hoping that this day would come, or if anything ever happened to me from a health standpoint, that she could step in. So it was a combination of luck of having somebody really amazing come on board with me, and then intentionality to try and make sure that she stayed with us, so that this day could someday come if it needed to.
She stayed. You were able to groom and teach and coach and all those things. Yeah.
We probably taught each other along the way, to be honest. Yeah. We grew up together in the business, to be honest with you. I just happened to be the one that founded it, and was the one that was the CEO. But she really was sort of that right-hand person that really helped me through a lot of difficult times. And so it's fun to be able to be on the other side of that and be the one that helps her. But it's been really good so far for her too. So
that's great.
A lot of that's down to her and her team. So
that's good. Yeah. All right, I want to circle back. I think you're the right person to do this, because ESOPs are complicated. We talked about that at the beginning, and sometimes they're really hard for people to understand exactly how they operate. Can we go back and talk about, just this 20% sale with the, we went real quick a while ago, talking about, okay, and then you have a 10-year note on that, and people's heads are exploding. They don't understand that. Can you kind of talk through what those steps are with an ESOP? I think you're the right guy for it.
Yeah, I will try. I think I can do a pretty good job of distilling it down, because I kind of have to go through it with my team as well and do it in a way that's digestible.
And you're a teacher. So. You're going to be teaching. So here you go.
So big picture ESOP, basically you're forming an entity that is going to either in a one transaction or a series of transaction buy the shares of your company. And so there's lots of ways that purchase can be structured, but that's really the ultimate outcome. And so that entity holds the shares, and then those shares are then allocated to the employees over a period of time, based on tenure or salary, or a combination of both. So
So the ESOP is created, and it's a qualified plan, which we'll probably have to get into here a little bit. Yeah, but it's qualified. And how does it get the shares?
Yeah. So there's several ways to structure the transaction. And by the way, as you say, it's a qualified plan. So this was set up in the 70s by the U.S. government to encourage. It's an ERISA plan to encourage, regulated by the Department of Labor and the IRS, to encourage employee ownership. And it is a great vehicle for it, to be honest with you. And I will tell you, it's no more expensive to implement an ESOP than it is to sell to private equity. Because you sell to private equity, you're going to have your own lawyer. You're going to have a whole bunch of lawyers. You're going to have transaction fees and broker fees and all those kind of things. I would say it is the same level of expense, and if you do it the right way, it can be very manageable from a cost perspective. Over
maybe even less expensive.
Yeah. Mm-hmm.
I mean, you have to do a valuation, obviously.
Yep.
Okay, and you have to have a trustee.
Yep.
Of some type, and all those kinds of things. So the
ESOP finances the purchase of the shares. So the ESOP is an entity that's created on day one. It doesn't have any sort of financial interest or anything.
Yeah, you do.
Yeah,
so you have the shares.
That's right.
So then you sell the shares to the ESOP.
That's right, and you can do that either in stages or 100%. A lot of the ones you hear about are 100% because a lot of these things, the owner waits, as you said earlier, until they're in their 70s, and then they have to sell all of it. Okay. So, but if you're, so what you typically do is you go to a bank and they'll finance a portion of it, and the collateral is the business itself. That they'll basically have an interest in the business itself, and if the ESOP defaults for some reason, then they own the business. Okay.
Yeah. So they're using the business itself as collateral. So,
but they typically can't do 100%. So then the seller, the owner, usually has to finance the balance. So if you're trying to sell 100%, the bank may finance 40%, and the owner has to do a seller note for the balance. And they're also subordinate, so the bank gets paid off first, and then the seller gets paid off. So.
Yeah. So one of the disadvantages is that like I think your company, kind of like mine, doesn't have to have a lot of leverage to operate in the first place.
Yeah. It's not a capital intensive business.
Exactly. But if you did, then this could be yet another layer of leverage within your business. It could also potentially handicap the business going forward in its ability to borrow money if it needs to borrow money for things like that. But in your case, it wasn't really an issue.
We had a clean balance sheet going into it. I would say a good candidate for an ESOP transaction is a company that has relatively predictable cash flow, because you're going to have debt that you've got to service, and it's got to have good free cash flow in order to do that. It also needs to be a company that's growing, because, it bought the shares at $26 a share, and it's going to allocate them to the employees, but the employees are going to want to see their shares grow, or it's not really going to be the value of their shares grow, or it's not going to be really meaningful
it needs to have growth. Right. Okay, so right now, all the shares are owned inside of the ESOP itself. When we started, it bought 20% of your shares. The transaction was leveraged by a bank.
Yep.
Okay.
Because we were only doing 20%, we were able to get it 100% financed by the bank.
Yeah. So the bank basically, paid you, paid you the money. The shares go into the ESOP itself, this entity.
Yeah.
Now what?
Yeah. So, or maybe even to put a finer point on it, the ESOP borrowed money and then turned around, and the ESOP gave me that money to buy my shares. So they own my shares now. And so those shares are held in trust, because it's actually a trust that you form. So that's what that entity becomes. And but now they own 20% of Venturity. Venturity's making money, and 20% of all profits now go to the ESOP. That goes to pay down the debt. As the debt gets paid down, the shares are given to the employees at no cost to them. So,
okay, so the profits come in, gets a share of the profits. That pays down the debt, and then incrementally, as the debt gets paid down, the shares get distributed.
Yep.
Okay.
Yep.
And all on a tax advantage basis.
Yeah, well, and that's the other thing. Yeah, there's no taxable impact to the team member, because they get that share, but they don't actually have to pay taxes on it until they at some point sell it back to the ESOP.
Right.
In the meantime, the other nice thing about the ESOP, you mentioned the tax advantage. So the ESOP it's a trust, it's an S corp, but the way the laws were written, it pays no taxes.
Yeah. That's huge.
So if you're 100% ESOP, all the profits that you distribute go to the ESOP, and then there's no taxes paid on them.
Any of it.
So it pays down the acquisition debt, a whole lot faster, because it's not paying a third faster, because you're not paying taxes on the income that goes.
Yeah, so it can really accelerate. That's why you're able to pay this down so fast, like in half the amount of time of the actual amortization. For instance.
Yeah, we signed a 10-year note on the first 20%, and we'll pay it down in just a little over 5 years.
Yeah. And then that distribution to the employees, they get those shares increase in value over time. And then eventually that becomes, part of their retirement.
Yep. So when they leave the company, there's obviously a vesting period for those shares, and they get allocated to them over a period of time. But, I looked at, we're about to distribute, we distribute shares every December 31st based on the debt that's been paid down. And so we give them a statement in April that shows them sort of what they're worth, because we have to do a valuation as well. And so, as I said, we're up to almost $65 a share now. And
double.
And in fact, I was just thinking about it just now. The statement I looked at, there was a participant whose shares were worth $3,000. Their ESOP account balance as of the end of 2022, they got allocated more shares, and the share price increased significantly. And now they have $10,000 in their ESOP account. Okay.
1 year later.
1 year later. So it almost tripled actually over the last year, because we grew a lot as Venturity. And so the share price went up, and we paid down a bunch of debt. So it can really start to accelerate. And so someone who stays with us for another sort of 10, 11 years, they will probably have $750,000 in their ESOP account. And they could leave the company at that point, or when they retire for the company, they can sell their shares back. So, and have that liquidity event. So,
and then just to go back, because this is the part that always trips everybody up, including me. So you're able to allocate the shares, because basically what happened is when you created the entity and then leveraged against the shares to pay the owner, then the value of the ESOP itself was in essence zero
on that day, right?
On that day, because it owned the shares, and yet there was a full loan out for that total amount
that secures the debt.
it.
Yeah. So.
But then it's that pay down of debt that creates the value within the ESOP itself, that then allows it to have value, that then gets distributed as shares to the employees.
That's exactly right.
Yeah. It's kind of complicated.
Yeah.
But it's cool.
Yeah, it's a cool setup, and I will tell you, as it really has taken sort of 2 to 3 years for it really to become meaningful. Our team members, as they're getting $10,000-$20,000 in their ESOP account, and they see the trajectory of where things are headed. It's going to be really meaningful wealth for their families. So, in addition to having their salary, and then having these open book management bonuses that we do, and those are cash bonuses.
That you're
gives them a
continuing
stake
with
in the
all
outcome.
that. Yeah.
So they have a real stake in the outcome of our profits. Now they have a real wealth building opportunity, a stake in the outcome as an owner, which is substantially a different way of looking at things. So, So it's been super interesting. So that's probably the best thing that, in a nutshell is that the ESOP is an entity that is able to buy the shares from me. As the debt gets paid down, they allocate to the employees. And so if it's 100% ESOP transaction, when all the debt is paid off, all of the employees own it. Now, it doesn't change the way the company is run on a day-to-day basis. You still have a leadership team.
Right.
And you're probably going to have a board if you're 100% ownership that oversees the CEO and the leadership team. But, the same people that were running Venturity the day before the ESOP are the same people that are running it afterwards. And you still have to have leadership transition and all those kind of things. But the individual employees are so much more invested in what's happening, and they see how they fit into creating wealth for not just the company, but for themselves. They're not just creating wealth for me anymore. They're creating wealth for themselves.
Yeah. So, which, another thing is, so we have kind of a new, different generation within our companies as well, that I think that this type of ownership, within a company, I think
absolutely.
I think it's something that, the younger generations appreciate probably a lot more than like you and I did when we first started.
Yeah, the millennials and Gen Z talk up. They feel like what's important to them is to have meaning in their work.
Absolutely.
And honestly, Robin, you and I really wanted the same thing when we came out of school. We were glad to have a job, etc. But we also wanted a job that we enjoyed and had meaning. We just didn't want to tell it. We couldn't tell anybody about
couldn't
that.
tell it. That's probably true.
I mean, really, when I went to work in public accounting, they're like, you're lucky to have this job. And if you don't want it, there's 10 people outside the door that will take it,
Yeah, I'll take it. I'll do whatever you tell me to do.
That's exactly right. But I think we all wanted those same things. There just wasn't those kind of opportunities. I think that's where, hey, I'm an old guy, but I certainly appreciate one shift in the workplace is I want to have work that has meaning as well. Mm-hmm. And so I think that's what everybody really wants. And so having an ESOP, having open book management and ESOP ownership brings more meaning to people's work. And I think that's one of the things that is great about millennials and Gen Z is they have this opportunity now. The world has changed, and they can express what we probably all wanted all along, which was work that had meaning.
And we can deliver on that. Yeah, through something creative
these
like
vehicles.
an ESOP.
Yeah, exactly.
Really cool.
Yeah. So,
well, good, outstanding, Chris. Congratulations on all your great success growing this business as a founder, successfully transitioning leadership, as well as ownership in a way that essentially looks like to me it's going to guarantee that your company will continue to have great success, even as you step away.
Well, I hope so. You never really know for sure.
You don't know, but it's got to make you feel pretty good.
It does. It does. Especially that, what makes me feel great is I'm very invested in the team's success going forward, not just as an owner, but they're my friends.
Yeah.
And so I want to see them be successful so they can find that meaning as well. And I feel super lucky in that we found these different ways to do this, and so hopefully it's going to continue, as you say. I hopefully, in working with my team, we've set it up for success going forward, and that's what's important to me. So.
It's really cool. Excellent, Chris McKee, chairman of the board of Venturity, founder. Huge success in that arena, as well as a great resource for all of us within the realm of financial accounting, as well as an expert on open book accounting and management. And
ESOP
sounds like he's going to be teaching ESOPs at SMU here before too long. So we got the first taste of that. Chris, if somebody on the show wants to get in contact with you and talk further about some of these things, what's a good way for them to contact you?
Yeah, Rob, I was going to say, look, I'm happy to, some of these areas are there's a lot of sort of detail below the surface.
Yeah.
With open book management, with ESOP ownership, with successful leadership transition, and we'll call it successful so far. It's been really good. So, and so I'm happy to go to lunch with someone or get on a call and go 4 levels deep on some of this stuff, because I'm very fortunate and I've learned a lot along the way. So just email me at chris@venturity.net, CHRIS @venturity.net, VENTURITY.net.
Okay.
Or they can reach out to you and you can connect us.
Yeah, you can always reach out to me, and I can connect y'all with anybody who's been on our show. We'll put in the show notes your email, so that
that's great.
Reach out.
Yeah,
and
I'm super passionate about all of this, and I'm happy to share my learnings. I learned a lot from a lot of other people in order to get here, so I'm happy to do that. So.
Well, we appreciate that. That's great. So use everybody that we have on the podcast as a resource, especially Chris here. And again, we appreciate having you on. I want to remind everybody we put one of these out every other week. Chris, you were on episode 13. We did via Zoom. The sound wasn't great, but that was a really good session. And I would encourage you, if you enjoyed our visit today, to go back and look at episode 13, because you can kind of see the difference.
The progression.
The progression is so cool. I did it, and I encourage you to do that. Go back and listen to episode 13 as well. And any others that we have. Again, we put it out every other week. We hope you tune in. We're here for the small business owner or closely held business owner, those of you who've founded businesses and are just looking for great resources and great ideas and people to talk to. This is the place where you can get it. We hope you have a great week. Take care.